So glad to have everybody here. Thank you for joining us. I'm Karl Frank, if we haven't met, and it's my pleasure to introduce our speaker today, Rob Burton, who's a certified public accountant. Rob speaks all over the state about these topics, so we're really lucky to have him, and he's a really nice guy. I thought what I would do is just kind of give you the overview first, though, because we've got a full house here and we've got a full house online as well. The Zoom is packed. So we would like questions, but we'd like them at the end, if that's okay. So everybody who's here in person, please jot down your notes and we'll just ask that at the end. And then everybody online, you've got a way to ask questions too. Even though we muted you and we made you invisible to protect your privacy, you can use the chat feature and just type in your question. At the end, we'll just ask Rob some answers. So please do that. And thank you again for joining us. Please like us on social media and follow us if you're not already on YouTube and LinkedIn and other places. We'd love to have you join our crowd. And some of you out there in the Zoom audience, I don't know. So thank you for getting to know us. We're a wealth management firm, and we bring in experts like Rob to help provide our clients a holistic financial planning service. So if you'd like to learn more about us, please go ahead and do that. Just click the links that you'll see in the website to get to know us. All right, a little bit about Rob, and then I'll hand it off to him. Rob began his professional career in Austin, Texas, where he focused on tax planning and compliance for individuals and businesses. In 1998, he became the CFO of a local law firm and served in that role for 21 years. But during those years, he always kept a private tax practice in order to keep current with tax laws and best practices in tax planning. It gave him extensive experience in tax compliance and planning for individuals, businesses, trusts, and estates, as well as a knowledge of all facets of business strategy and operations. He earned his BS in business administration from Texas State and is a CPA both in Colorado and Texas. Rob lives in Wilton County, who's an accomplished poet and writer. He married up. They have two daughters who still think their dad is out of touch, which I think is a really kind way to say it. All of us who have kids in their 20s know that out of touch would not be the words our kids would use to describe us. We'd be a little bit stronger language, but we love all these kids, right? They're now independent, sort of, most. No matter how many years of experience he had under his belt, when not working with clients, you can usually find Rob riding his road bike on the roads of Colorado, something we all love here in Colorado and other beautiful areas around the country. Please give Rob a warm welcome. Thank you, Rob, for being here.
Great. Thanks, Karl, very much for that introduction. And yeah, you've obviously been talking to my wife because she also tells everybody that I married up, and she's right. So thanks to A&I Wealth Management for hosting me today. I really appreciate it. Thanks to Karl and to Stacy and to Chanel for getting all this organized and set up. I'm always impressed whenever I can get a group of people in a room or on an online seminar like this to hear somebody talk about taxes for an hour or 40 minutes, whatever it generally is. Not the sexiest of topics, obviously, but something we all need to be familiar with and well versed in. And with this big new tax law this year, I think it's something that's on everybody's mind. So I'm very happy to be here and happy to make my presentation today and then answer any questions that people have. So with that, I am going to get started. I'm going to just jump past the introductory stuff, but I'll talk about our agenda really quickly. So I'm going to talk about the individual provisions, the business provisions, some clean energy incentives, and then interestingly at the end, some notable omissions if we have time for that. We'll get to that as well. By way of introduction, I just want to talk a little bit about the tax law. I'll give you a little bit of context about it. There is a lot of media out there about it. I've been doing this public practice now for over 30 years, and social media has changed our professional lives so much because there is so much information out there now and misinformation out there now about so many things, but certainly about the tax law. So that's one thing I did want to mention today. The official name of the bill, we all call it the One Big Beautiful Bill Act. I'm going to call it OB3 today for the most part, or I'll call it the law. It was signed into law on July 4th, 2025. Interestingly, the short name, which was in the bill originally, was removed during the Senate amendment process. So the official name of it now is actually Public Law Number 119-21, or an act to provide for reconciliation and so forth. I just want you to know that because you'll see out there on the internet and when you're reading, it is still frequently referred to as Public Law 119-21. Some people are opposed to using the term One Big Beautiful Bill. Act, and so they choose to refer to it in all different sorts of ways. What makes this new law so confusing, both for practitioners and for taxpayers? In my opinion, one of the main things is that this new law extends many things that were set to expire in 2025 and 2026. So it's not all new law. A lot of the bill says for those laws that were enacted in 2018 under the Tax Cuts and Jobs Act that were set to expire at the end of 2025, mostly, some at the end of 2026, now we're going to extend those. They also added some new law to it as well. So that makes it a little bit of more confusing than typical new tax law. The other thing I want to make sure I'm clear about today is that I'll be using the term permanent versus expiring tax laws. What we mean by that is that permanent means there is no set expiration date, because technically no tax law is permanent, because a new Congress can come in and write a whole new tax law and it can change everything. So from a technical sense, tax law is never permanent, but there's a distinction between what is set to expire now or what is, we'll call it permanent, meaning it has no expiration date and it won't change until Congress writes a new tax law. And the other thing I just want to caution about is there has been months and months of media coverage while this bill was in the House and Senate. And that's back to my point about social media. There is an enormous amount of misinformation out there about this new law because there were major changes made to the law in the 11th hour by the amendment process and the reconciliation process. And so even as I have been gathering my own information about this, if I attempt to use ChatGPT or Gemini for AI to research the law, I am frequently getting wrong answers because they're referring to a House version or a Senate version prior to the bill actually being passed into law on July 4th. So as you're doing your own research, as you're learning about it, just be aware of that and know that sometimes you may be getting bad information because there's so much of it out there. My presentation today is going to be targeted mostly towards action items for 2025 and 26. I'm hoping to really bring you something you can use. It will not be comprehensive. I am going to try to pay careful attention to the effective dates. And then the last thing I'll say before I dive into the details is right now we really only have the law. And the way tax law works is Congress passes a law. The Treasury Department then takes that law, working with the IRS. They work on regulations, guidelines, revenue procedures. The IRS will actually issue FAQs now, et cetera. We don't really have any of that yet. So there's a lot of questions out there about the real sort of meat on the bones of this law that we just can't answer yet until we get some of that guidance from the Treasury Department and the IRS. All right, let's jump into the individual tax provisions. So the Taxpayer Cut and Jobs Act from 2018, this was the Trump tax bill when he was elected president the first time. It changed the tax rates. It lowered them a lot in 2018, but those lower tax rates were set to expire at the end of 2025. Those rates have now been made permanent, and under the current law, they will not expire. And the rate brackets will continue to be indexed for inflation, which was something that was talked about. The brackets have always been indexed for inflation for as long as I can remember, but that will continue. I'm going to show you the rates in the bracket. So here's our 2025 income tax rates. And it's important to note that the tax rates are on the left side of this chart. The tax brackets are the right three columns, okay? And those are the dollar amounts that determine the income amounts based on your filing status that put you into the tax rate. So the tax rates on the left will not change. The brackets on the right, they change every year slightly because they do get indexed for inflation. So they'll go up a little bit each year. So you can actually move from one rate to another just by virtue of the inflationary changes to the brackets. But the good news is those lower rates are not going to change. We all did expect that they would as a result of this new law, and I'm a little surprised as a practitioner to see if they stay the same. Here's the big one, and I tried to put some of this stuff at the front that I thought people might be most interested in. We've been talking about this. Well, we've been talking about the estate and gift tax exemption for over 30 years since I've been practicing. When I started my career in 1991, the estate and gift tax exemption was $600,000. It then moved up to $1 million. It's bounced around, but the Tax Cut and Jobs Act had increased the amount to 11,180,000 and then indexed it for inflation, but is expected to expire at the end of 2025 and go back down to about $7 million. This new law has now made it permanent. It's increased it to $15 million effective for 2025, and it will be indexed for inflation. So that is a huge relief to a lot of me, a lot of practitioners, and our clients, because we had been doing a lot of planning for those clients of ours who were somewhere between that $7 million number where it was supposed to go back down to, and the 13,990, which is where it was for 2025 before the new law came into effect. So that's good news. Good news for planning. Good news for a lot of people who had their estate plans out there. The portability election for a surviving spouse that came in just a few years ago. It's a relatively new part of the tax law. It is still in effect, so it did not get changed. It did not get eliminated by this new law. The generation skipping transfer tax exemption is now equal to the estate and gift tax exclusion amount. It's $15 million, but that GST exemption is not portable. So the estate and gift tax exemption is portable. The GST exemption is not. The SALT cap. This is the state and local income tax cap that we probably are all familiar with, $10,000 since the new tax law came out in 2018. So this new bill, OB3, has increased the cap to $40,000 starting in 2025, and then it will be indexed for inflation 1% year over year through 2029, when it then reverts back to $10,000 in 2030. So the good news is they raised the SALT cap. The bad news is that they've put an income limit on it, so it's going to phase down starting at a $500,000 modified adjusted gross income. And I won't get too much into the formula here, but it's basically going to start phasing down if your income, your modified adjusted gross income is more than $500,000. And at $600,000, it's going to get down to a floor of $10,000. And that's as low as a SALT deduction can go. So for higher income taxpayers, this is really an irrelevant change because your cap, if you're above the $600,000 in income, and that's for the married filing joint, should have mentioned that, your cap is still going to be the $10,000. So what that means, and I'll talk about it in a minute, is that for those of you who are business owners or who have an interest in pass-through entities of some sort, the PTE election, some of you may have heard about, which is a workaround that the tax sort of law community came out with in 2018, that PTE is still going to be a very important part of what we do for our clients who have high state and local taxes. And remember, state and local taxes include your state income tax, your property taxes. Those are the two largest components of it. And it's very easy to get above that $40,000 very quickly. It's much easier even to get above the $10,000. All right, the child tax credit, this is a minor one, but just important for everybody to know that they have increased the child tax credit, permanent increase to $2,200 per child, and they've added a $1,400 refundable portion, and that will be inflation adjusted each year. But this also phases out at income threshold amounts of $400,000 for married filing joint and $200,000 for single or married filing separate taxpayers. All right, so let's talk about some of the new tax provisions. What we just covered were those things that affected individuals mostly that were just extensions of the Tax Cuts and Jobs Act or eliminated the expiration dates on the Tax Cut and Jobs Act. But here's some things that are actually completely newly written law. All right, the Trump accounts. And I will note in this slide, for those of you, I don't know if you have written slides there or printed slides, I did find a typo in this one that I struck out on that third bullet point. I'll talk about that in a minute. But the Trump accounts, these are a new type of tax exempt savings account for children. They are intended to be used for qualified expenses, and the things that we have been told so far is higher education, small business loans, or first-time purchase of a principal residence. This is a perfect area where I think that once the IRS and the Treasury Department come out with more guidance, they're going to give us a lot more information about what those qualified expenses are, and how these are going to work. This is one of the first areas we're looking at right now that we just only have, I'm going to say maybe 5% of the information we need to really know how these Trump accounts are going to be handled. There's a lot more guidance that's going to be forthcoming. But basically, it's kind of like an IRA, I'll call it. And this is another one where there's been a lot of misinformation about these. So I'll give you a little bit of details. The contributions that go into these accounts are not going to be tax deductible. Right. So the way they're intended to work is that the government for children born from 2025 through 2028 The government will start an account with $1,000. Our understanding right now is it's for all children. There are no limitations on who that will be. And then parents, grandparents, siblings, other family members can contribute up to another $5,000 to these accounts. Similar to an IRA. The misinformation piece is that some people have been saying that when the child turns 18 and they start withdrawing the money for these qualified expenses, that those withdrawals will be tax-free, and that is not correct. At age 18, when they start taking the withdrawals, or later, but they can start taking the withdrawals at age 18, the income that comes out of these is subject to tax, ordinary income tax. And if they don't use these amounts for qualified expenses, then they'll also have to pay the 10% penalty for withdrawing the money before they've reached age 59 and a half. So it gets a little bit confusing. Just wanted to mention that. There is a lot more to this. I'm not going to get into too much details. It's just kind of beyond the scope. But there are provisions where employers can contribute money to these. And actually, like government entities, tribal groups, etc., can also set up programs where they will be able to fund these accounts as well. A lot more information to come on that. If it's something that interests you, stay tuned. I'm not really seeing the advantage to these over a 529 plan, especially now. We'll talk about in a minute how the 529 plans have been greatly expanded. But there may be reasons that these Trump accounts are going to work. I understand the social and the sort of the political reasons for them, but as a taxpayer and a practitioner, I just don't see why I would use this particularly over a 529 plan, just from a general sense. A little bit more information about those. I'm going to go ahead and skip over this because I talked about it a little bit. Again, we've got a lot more guidance coming about this. Tips deduction. This is probably not going to affect too many of the people on the call today or in the room today. But in case you're a business owner of some sort that pays tips, just wanted to make you aware of this new law. There's been a lot of talk about this. So the new law is they've added a tips deduction of $25,000 for taxpayers of under $300,000 married filing joint or $150,000 filing single. There's been a lot of talk about manipulating this, right? Like the joke among my office has been, well, we'll just start working for tips, right? Instead of charging a fee for our tax work, we're just going to ask for tips. So the IRS, I'm sorry, the Congress, they thought ahead of that. And the law specifically says that this will be reserved for occupations only where tips were already customary prior to the enactment of OB3. So there was a lot of talk over the last year or so as this bill started coming together. I mean, not a year, maybe 6 months, that this would be manipulated, and they've sort of closed that opportunity because they're going to come out with a list of occupations that qualify for this, but we expect it to only be those that were already customarily tip occupations prior to the new law. This was another one of those sort of permanent versus expiration date types of tax laws. You'll notice that this one is effective only for 2025 through 2028. Overtime deduction, another one I don't expect it's going to impact a whole lot of you unless you own businesses that pay overtime. But they have added a whole new law around deduction for overtime pay, $12,500. It has the same income phase outs as the tips deduction had on the previous slide. There's been a lot of questions about this one, but this deduction is going to be only for the compensation amount over the base pay. So if someone works overtime and they get paid time and a half, they're only going to get the deduction for the half. They don't get the deduction for the first hour, we'll call it, the first base pay. If they get double time or holiday pay, whatever the supplemental pay is, it's going to be included in this deduction, but the base pay will not be included. This is another one. It's effective only for 2025 through 2028 tax years. The auto loan interest deduction. This is a new deduction that's been added, $10,000 of interest, new car loans only, effective 2025 through 2028. There are some qualifications. It must be a U.S. assembled passenger vehicle. And the way to find that out is there's a website out there that you can go out and you can actually type in the VIN of a vehicle. We've been using it for a few years to confirm that EVs qualified for the EV credit after the new law passed a few years ago. They'll use the same website for this. So you can type in the VIN of your vehicle, verify that it qualifies as a U.S. assembled passenger vehicle, and then you can get the $10,000 of interest on the new car loan. That'll be a deduction. and the loan must be secured by the vehicle. Charitable deduction for non-itemizers. This is a new one, sort of. We saw this during COVID. The IRS came out with a special sort of transition law for a couple of years where even if you don't itemize, and a lot of people nowadays don't itemize, we'll talk more about that in a minute, but when the Tax Cut and Jobs Act of 2018 came out, it changed the standard deduction. It raised the standard deduction so high that there are a lot of taxpayers now who no longer itemize. And so if you're not in the itemizing category, you generally don't get benefit of your charitable contributions, tax benefit, I'll say. And we've got all sorts of strategies. I'm sure that A&I has discussed with all of you strategies, how you can maximize your charitable contributions to sort of help you with that. But in this case, they've now added back this charitable deduction for non-itemizers. So even if you don't itemize, you'll now get a $1,000 deduction for single filers or a $2,000 deduction for married filing joint. It's cash deductions only, made directly to the charity, to the qualified charity. So this will not count for donor advised fund contributions. So this has got to be cash paid directly, and it also won't non-cash contributions. So goodwill, art donations, etc., won't qualify for this also. This one actually does not start until 2026. So this is one of the ones that does not start this year for 25. It starts next year. All right, so this is a little bit more relevant probably to many of you. They've put a limit on the charitable deductions for individuals who itemize. So the previous one, we were talking about people who don't itemize. Now we're talking about the ones who do itemize. Historically, charitable contributions have been deductible without limitation unless they got to a very large amount and they were limited by 60% or 30% of your AJI potentially. This is a completely different type of law, I'll call it. This is not an upper limit. This is actually what we call a lower limit. It's almost like a floor. So now think of it this way. If you itemize deductions and you take charitable deductions each year as part of those itemized deductions, you're going to lose from those deductions, you're going to lose 0.5% of your modified adjusted gross income you're not going to get of those deductions. So let's say if your adjusted gross income or modified adjusted gross income $500,000, then you're going to lose 0.5% of that. It just gets taken off the bottom, and you will not get that deduction, and it does not carry forward. That's been a little bit of misinformation out there about that. So there's been some saying, well, that will carry forward. You'll get to use it in a later year. That is not accurate. You just completely lose that 0.5%. And this applies to everyone making charitable contributions who itemize. Not a huge loss. I've already had a few clients call me and they want to maximize their charitable deductions this year to their donor advised fund so that they don't get that 5 or 0.5% haircut over the next few years. I do think that's a worthwhile strategy, depending on how high your adjusted gross income is. That would be a way to do it. If you already utilize a donor advised fund, make a large donation this year, it will not be subject to this 0.5% haircut. And then in the future years, you keep them lower and you don't lose as much off of your charitable deductions, because this does start in 2026, not in 2025. So we've got some time to plan around this a little bit. All right, this is probably one of the ones that had the most misinformation out there about it as the law came together, and it was exacerbated. That misinformation was made worse by the email that the Social Security Administration sent out a couple of days after the law passed. I got it. I don't know why I'm not on Social Security yet, but I got the email. Many other people did as well. And it was effectively saying that Social Security benefits were no longer going to be taxed. And that is just not true. There's been a lot of misinformation out there about, okay, they're not going to tax Social Security anymore, etc. There is nothing in this tax law that changes the tax treatment, directly changes the tax treatment of Social Security benefits. Now, indirectly, this is going to impact that. So it's a new deduction for seniors. So 65 and over, each person, if you're married filing joint and you're both over 65 or older, you're going to each get a $6,000 new deduction for seniors from 2025 to 2028, but it will be phased out at higher incomes. Okay. So it phases out at a modified adjusted gross income of over $150,000. Well, it's pretty easy to get to $150,000 and then you're going to lose this deduction. Okay, that's for married filing joint, 75,000 for single. If you qualify for this, it is in addition to the already higher standard deduction that seniors get anyway. So seniors already get a higher standard deduction. Now you'll get this additional $6,000 bonus deduction for seniors. And one thing that's important to note, I should have mentioned this earlier, is a lot of these new deductions, the tips deduction, the overtime deduction, this new senior deduction, etc. These are all deductions that you're going to get even if you don't itemize deductions. These are like a special category that they're going to have to actually modify the tax forms for, that these are going to be things that you're going to get them even if you're not an itemizer. And that's a really important distinction. So if you're under the AGI limits, this is a nice deduction. And what it effectively does is if you are under the AGI limits, the way the math works out is that it will make Social Security non-taxable for most taxpayers who qualify for this. But for taxpayers who are over $150,000 adjusted gross income, they're not going to get this deduction. It changes nothing about your Social Security benefits taxation. So that's why I felt like it was really misleading. There's a lot of really bad information out there about this one. So I just kind of wanted to really emphasize this one and make sure that's clear. The mortgage interest deduction, this is a new one that was really an extension of the 2018 Tax Cuts and Jobs Act. It came out with a limit of $750,000 mortgage principal balance for mortgage interest deduction. So what that means, and sometimes there's confusion about this, is that if you have mortgages, primary residence, second home, vacation home, etc., this doesn't qualify to rental properties. So disregard rental properties for this purpose. But if you have personal use homes and you have mortgages on those and your balance is greater than $750,000 on combining those mortgages, then you don't get to deduct the interest on the portion of the mortgage that is greater than $750,000. That number used to be $1 million. The 2018 tax law changed it, they lowered it to $750,000. We thought it was going to go back up when it expired at the end of 2025, and they made this permanent. So it's now at $750,000. So something just to be aware of, if you've got mortgages exceeding that, you're going to lose the tax deduction for the interest on the portion that's over the limit. And then one other thing that this new law added back that was taken away in 2018 was the PMI deduction. So the OB3, the new law, has now restored the deduction for private mortgage insurance. It's going to be treated just like mortgage interest. But this particular deduction has an income phase out starting at $100,000. So if your income is more than $100,000, you don't get PMI deduction. But let me be real clear about this because there's been a lot of confusion and misinformation about this. People have been misunderstanding that this $100,000 limit only applies to the PMI. Okay, it doesn't apply to the typical mortgage interest deduction. So that's all it is. So I've had some people panic. They're like, oh, my income's over $100,000. I don't get any mortgage interest deduction. That's not accurate. The $100,000 income phase out is only for that PMI change. You still get the mortgage interest deduction on mortgages up to $750,000. I put a note in here, and I'll mention this later as well. I said, watch the interest tracing rules here. Depending on your tax advisor and sort of their sort of level of conservative approach or aggressive approach and your own risk profile, we do typically look carefully at how mortgage interest money is being used. And there are laws, sort of case law and regulations in the IRS code that are called interest tracing rules. And if you can trace the interest on a mortgage to show that it was maybe used for another deductible type of purpose, then you might be able to get around the $750,000 limit. And what I mean by that is, let's say you've got a $750,000 mortgage on your primary residence. The interest on that is all deductible. Let's say you take out a $500,000 second mortgage on it to start a business. There are rules that say that you could use, because you use that $500,000 for a business, that even though it's a mortgage on your residence, a second mortgage on your residence, because you use it for another, you can trace the money to a typical deductible use, then you would be able to deduct that interest. So that's a real interesting planning tip that we use for people oftentimes if the clients are willing to take that position. All right, here's some other Tax Cuts and Jobs Act provisions that were made permanent. I talked about this one earlier, the standard deduction. They have been made permanent. We mentioned it. Here are the new standard deduction amounts. The one reason I wanted to bring this up again is that if you notice at the bottom of this slide, the important note is that there is a new limitation in this law that effectively caps itemized deductions at a 35% tax rate benefit. So there's a complex formula that they've put into the law, but basically what it results in is that if you are in the 37% tax bracket, then you're going to lose some of your itemized deductions at the top, and you're effectively going to get only a 35% tax benefit from your itemized deductions, not a 37% tax benefit as you ordinarily would under the way they did it previously. There are some alternative minimum tax changes. For the first, I'm going to say 25-ish years of my career, AMT was a big deal. The Tax Cut and Jobs Act made some changes to it. It didn't take it away, but it made some changes to it that I have very few clients who fall into AMT over the last 4 or 5 years. It just hasn't been as relevant. These new changes are going to change that. I don't think it's going to apply to everybody again like it used to. Not everybody, but the majority of taxpayers, high income taxpayers. But I do think it's really important to pay attention that if you haven't been subject to AMT the last, say, since 2018, we'll say, so 6 years, but you were previously subject to AMT, you really want to pay attention because you might get back into AMT again. The exemptions of $1 million for married filing joint and $500,000 for single taxpayers, they now made that permanent. But what they did is they increased the phase out rate for this to 50% of the amount that the taxpayer's alternative minimum taxable income exceeds a threshold amount. I wasn't going to get into the details on this a whole lot. It's a fairly complicated area of the law, kind of beyond the scope of this presentation, but did just want to point this out, that talk to your tax advisor and just make sure they're paying attention for your 2025 tax year. Is there a possibility you're going to be an AMT? And especially if you recall a few minutes ago, I was talking about maximizing donor advised fund contributions this year potentially. If you go too high, that actually could be one thing that would throw you into AMT. So as we're doing planning for our clients right now, looking at can we maximize their charitable contributions this year through a donor advised fund, we've got to be really careful that we don't push it so high that we get into an AMT problem for this year. So something to pay attention to. Interest on home equity debt. This is kind of related back to that interest tracing rules that I mentioned earlier. The new law eliminates the interest on home equity debt. This was changed in the Tax Cut and Jobs Act. And basically what it said is that if you take out a second mortgage or any kind of home equity debt, that unless it was used for qualifying purposes, buying, building, or substantially improving the taxpayer's home, that interest was not deductible. Because prior to that law in 2018, you could take out home equity debt, pay off credit cards, which normally credit card interest is not a deductible interest. But if you took out home equity debt, paid off credit cards, and used the loan to do that, then the interest on that loan was now deductible because it was a home equity loan. The 2018 law said, nope, we're not going to allow that. It's got to only be used for buying, building, or substantially improving the taxpayer's home in order to be deductible. They've now made that provision permanent. But now this is another area where interest tracing rules are really important, because we again take the position, and we feel this is very sustainable, very supportable with the IRS if it's ever questioned, that if you take out home equity debt of any sort and you use that for what would traditionally be a deductible purpose, buying a rental property or some sort of investment property, buying a business, starting a business, etc., that through the interest tracing rules, we do believe that that home equity debt interest would still be deductible. And that's pretty common throughout the practitioner community. So it's a really important planning tip for you. Personal exemptions, these are now completely gone. Many of you may remember that prior to 2018, we had a low standard deduction, and then you also had the personal exemption, which was usually just a few $1,000s. It was kind of like another deduction, but it was called an exemption. These are now gone permanently. They were taken out in 2018. We thought they would come back for 2026. They're not coming back, at least under this current law. They've made the $500 credit for qualifying dependent a permanent now. Miscellaneous itemized deductions. This is a big one, especially for A&I Wealth Management and financial advisory firms, because they're one of the ones that are most impacted by this. Prior to 2018, you had what were called miscellaneous itemized deductions, and they were deductible subject to an 2% of your adjusted gross income floor. The 2018 tax law completely eliminated those, right? So these are things like unreimbursed employee expenses, club and union dues, hobby expenses, etc. And the reason I mentioned the financial advisors is because investment expenses fall into this category. So investment management fees used to be deductible prior to 2018 as a miscellaneous itemized deduction that got taken away temporarily with 2018. It's now been made permanent. Those deductions are all completely gone. And that second bullet point was just a little accountant humor. I know it's hard to tell, but there goes that safe deposit box deduction, right? I can't tell you back in the day when we had miscellaneous itemized deductions, how many of my clients would chase down that $35 a year, whatever it was that they paid for their safe deposit box fee. They'd go to the ends of the earth to provide me that $35 deduction. I'd say it's just not worth it, but they wanted to take it. So I'm not upset that the safe deposit box fee deduction goes away. I do wish we could get the investment expenses back because many of my clients pay those, and we would like to see them get the benefit of a deduction for those. All right, a few other changes. Wagering losses. I don't know if we have any gamblers in the room. You don't have to out yourself if you are. Maybe we even have some professional gamblers. I do have a couple of clients who are professional gamblers, and so we have to pay careful attention to these. They've added a new law in OB3 that limits the losses from wagering transactions to 90% of the amount of such losses. So as you're doing the calculation, the old law still applies. You can only take losses to the extent of your winnings, but you can only use 90% of your losses to get there. So again, probably doesn't affect a whole lot of people, but for those that it does, this is a really big deal because I do have a couple of professional gambler clients. They have some good years, they have some really bad years occasionally. And in those really bad years, when they have net losses, they don't get to deduct any of those net losses. All they get to do is show a break even on their tax return, and the additional losses are just lost forever. They're just gone. The new 529 plan rules, pay careful attention to these. We're expecting a lot more guidance on these from the Treasury Department and the IRS, but they've basically changed the category of things that 529 plan distributions can now be used for. So they greatly expanded it. And we're expecting it to even get broader once the Treasury Department releases their regulations for us. But it now allows tax exempt distributions from 529 plans for attendance or enrollment at elementary schools, secondary schools, homeschool expenses. And in that second bullet point, same thing, it's for qualified post-secondary credentialing expenses. So it could be study and testing fees for the CPA exam, the bar exam, the medical exam, financial industry exams, vocational technical credentials, any of those kinds of things are now, under the law anyway, going to be qualified expenses. All right, some business provisions. Bonus depreciation, this is a big one. Bonus depreciation used to be 100%. It started going down in 2018. It was scheduled to drop down all the way to zero at some point. It has now been made permanent at 100%. Starting January 19th, 2025, bonus depreciation for this year, starting at that date, for assets acquired after January 19th is now 100%. This is a big deal for our clients. We're really focused on this. There's also the Section 179 deduction, which is kind of like bonus depreciation. It is still in place and it's been expanded a little bit. It's been given some higher limits, but it's got more limitations on it than bonus depreciation does. So this is a big win for the business owners out there. Interesting to me that they used the January 19, 2025. That was a political move. Obviously, that was inauguration date, was the next day. So basically, if you bought assets on inauguration day or later, you now get 100% bonus depreciation. R&D expenses. This is a fairly technical item. I'm not going to spend a lot of time on, but if you own a business and you had R&D expenses, in a few years ago, they took the deduction away for that. and said, now if you spend money on research and development in your business, you have to amortize those expenses over 15 years. You don't just get an immediate deduction for them. That was a huge change from the days when it was an immediate deduction. And it really sort of injured a lot of my clients, I'll say, because they lost that big deduction for that money they were spending. So that is now back. And if you've been amortizing R&D expenses in your business the last few years under the new law, there are some transition rules that say under certain circumstances, you can just take the remaining unamortized amount in 2025 as just a big deduction, which could be a huge tax savings for businesses. And there's some other provisions that say you could actually go back and amend tax returns from 2021 forward, and go back, and instead of amortizing those expenses, you could go back and take the full deduction in those years with an amended tax return. So again, it gets really complicated. I'm not going to spend a whole lot of time on it, but just be aware of that if that impacts you as a business owner. The QBI deduction remains in place. For those of you who are not familiar with this, or maybe don't use that same terminology, this is the 20% deduction that came out in the Tax Cut and Jobs Act 2018, where if you own a business or if you have pass-through income from a business, a pass-through entity, then you get to take a deduction of 20% of that income against your taxes. And this was put in to try to make the tax rate sort of equal between business owners who had self-employed small businesses, S-corps, partnerships, to make them almost equal to C-corp tax rates. When they lowered the C-corp tax rates, this was kind of a nod to that. This has now been made permanent. It's been expanded slightly. And they have increased the phase-out ranges to $150,000 married filing joint, $75,000 single, which will allow some more higher income taxpayers to take the deduction. So we're glad to see that stay in. Some other important items. This first one you may or may not be familiar with. Most people call it the qualified small business stock. I call it the Section 1202 stock exclusion. I promise this is the only code section that I put in this presentation. But the qualified small business stock is a really great deal for people who are founders of businesses. And basically what it is, that if you start a business in a C Corp structure, a C corporation structure, under certain rules, and they're pretty generous rules, is that you can start that business and build the value, and depending on the holding period of that, when you ultimately sell out of that business, you can actually have that be the gain on that sale completely tax-free, or you can have 50% of it be tax-free, 75% tax-free, etc. So I have some business owners who start new businesses specifically with this in mind, and they end up with, a very large gain on the sale of their stock 5, 10, 15 years down the road. That potentially can be completely tax-free, not tax deferred, but truly just tax-free. You just never pay tax on that gain. So really, really good thing that they've made this permanent. We love this. And they've also made the opportunity zones permanent now with a rolling 10-year system. They were supposed to expire at the end of 2025. They've now been made permanent. So that rolling 10-year system, that refers to the holding period in order to be able to qualify. All right, clean energy provisions. I know we're getting short on time here, but these are really important. I've had a lot of questions about these. So if you're wanting to do solar panels, do them before the end of this year, because that solar panel credit is going to expire December 31st, 2025. They have to be finished, completely finished, in use, and paid for before December 30 or by December 31st of this year in order for you to get that credit. So it goes completely away 2026 and beyond. And and again, nothing's permanent in the tax law, but as of right now, there is no date for that to come back. Similar thing for the EV credits. So all categories of EV credits, that credit is going to expire if you don't purchase and take delivery no later than September 30th of this year, 2025. You're no longer going to get the credit. Now that's for the federal credit. The Colorado credit, as far as we know right now, is not going to change. We don't expect it to. So there still will be a Colorado clean vehicle credit for EVs, but the federal credit of $7,500 is going to go away after 9/30 this year. And then the EV charging stations is going to go away as of June 30th of 2026. So if you're going to get your EV this year before September 30th and get the credit, and you want to put one of the chargers in your garage, make sure you do that before June 30th of next year in order to be able to get that credit. The energy efficient home improvement credits, I've got that in here. They're fairly complicated, but just know that some of them are going to go away by December 31st. Some are going to go away by June 30th of next year. But the bottom line is that most of them are going away completely by June 30th of next year. So if you're wanting to do any energy efficient home improvements to your house this year, get those in place and in service by December 31st in order to get the various credits that are available. This is windows, doors, additional insulation. You can get an energy home audit, etc. Those are the kinds of things that fall into that category. And then the last thing is some notable omissions that didn't get into the law that we were all expecting. And there was a lot of teeth gnashing about this over the last few months. Remember back when we talked about the SALT cap has been expanded to $40,000 for some taxpayers. They did not change the PTE-T election. I call it the PTE election, which basically means that you can have, if you participate in a pass-through entity, you can have the pass-through entity pay the taxes on that income at the entity level, which then allows you a sort of a workaround where you can take a deduction in an indirect way for more than the $10,000 or the $40,000 under the new law of SALT deductions. We have used this a lot for our business owner clients in the last couple of years. It's been a huge benefit. It's very complex. It's kind of a mess, but it really results in a pretty good tax savings for a lot of our clients we've been using who own pass-through entity type businesses, or they are partners or shareholders in partnerships and S corps. Notable omission, there was no increase to the top tax rate on millionaires. There was a lot of talk about that. Obviously, it didn't change. Our top tax rate is still the 37%. There were no changes of note to the health savings account. There were no enhancements. I, frankly, as a practitioner, and I think our practitioner community expected changes. We did not see any changes to HSA accounts, so they're effectively stayed the same. And then the last item is there were no changes to the corporate tax rates. So this was a big one because in 2018, they lowered the corporate tax rate for C corporations to a 21% flat rate. And that was a huge change. I mean, prior to 2018, there were a lot of reasons to not have a C corp if you were a small business. 2018 changed that, made it a little bit more favorable because of the tax rates. But we weren't doing a lot of sort of planning around using C corps because we thought this was going to expire at the end of 2025 and go back to the old higher rates. Well, now that they've made those lower rates permanent, there's a good chance that we're going to start doing some more planning around using C corps for small business owners. I know that was a lot of information. It was quick. I'm going to stop there. I'm going to present the A&I disclosure and turn it back over to the room.
Thanks, Rob. You did a great job keeping us compliant. Thank you so much. Rob, thank you for that. And if there's questions in the room, please go ahead and ask them right now. Everybody online, use the chat feature at the bottom of the Zoom window to type in your questions. Cassidy will bring them up to me. Before we take questions, though, please do follow us on LinkedIn, like us on Google, like us on Facebook, follow us on YouTube, and subscribe to our podcast, the Expert Network Team. And our next event is coming up here real soon on the 26th. We've got an expert to give us information about college invest 529 plans here in Colorado. So I am open for questions, and I will translate them off to the expert.